This video is generated using NotebookLM for educational purpose only, and thank you and enjoy the video.
Welcome to The Explainer. Today we're dissecting a massive, seismic shift in artificial intelligence funding. We're actually stepping completely outside that standard Silicon Valley narrative you hear every day to examine a deal that is literally rewriting how AI startups get their capital. It's a crazy story about existential threats, sovereign infrastructure, and legacy tech giants absolutely fighting for their future. Let's get right into it. $1.5 billion. Let that sink in for a second. That is the explosive post-money valuation of a rising AI startup that is currently sending shockwaves through the entire global tech sector. And here is the headline that triggered this whole shift. HCLTech, an absolute giant in established IT services, is leading a colossal $300 million funding round in a Bengaluru-based AI startup called Sarvam AI. Now, make no mistake, this isn't just your standard tech investment. We're looking at a fundamental pivot in corporate strategy. And the sheer velocity of this company's growth, it's just staggering. 7 times. That is the dramatic valuation jump Sarvam AI has pulled off since their $41 million Series A round, and that was just in December of 2023. In roughly half a year, they multiply their worth by 7. Which brings up a really, really important question. Why is India's third largest IT firm, a company traditionally known for outsourcing and software services, suddenly writing 9-figure checks to an early-stage startup? Legacy IT is usually highly conservative. So what exactly changed? Well, the answer is fear. Or actually, let's call it an existential threat. AI is fundamentally rewriting the economics of software development. Think about it. The entire traditional Indian IT business model relies heavily on labor arbitrage, hiring thousands of engineers in Bengaluru to service clients in New York or London. But when AI-powered coding tools step in, they severely compress that margin advantage. HCLTech literally had to act defensively. And the absolutely crucial point here is this. HCLTech is not acting like a standard venture capitalist right now. They aren't crossing their fingers hoping Sarvam AI has an IPO in 5 years for a 10x return. No, this $150 million check, it's an insurance policy. It's designed specifically to protect and upgrade HCLTech's staggering $14.5 billion revenue base. They are hedging against their own disruption. But wait, let's flip the lens for a second. How on earth did Sarvam AI, a company founded by Vivek Raghavan and Pratyush Kumar in July of 2023, manage to secure this massive syndicate of investors? What makes them so incredibly special? Well, if we follow the money, or rather follow the hardware, we find a massive infrastructure moat. Sarvam AI somehow managed to secure 4,096 highly coveted Nvidia H100 GPUs. And the kicker? They didn't buy these on the open market at some massive premium. They secured them through the government-backed India AI mission. And this is exactly where capital efficiency comes into play. To put that into perspective, that government subsidy translates to roughly $12 million in infrastructure savings. That just drastically reduced Sarvam's need for early dilutive venture capital, which gave them immense leverage when they sat down at the negotiating table with heavyweights like HCLTech. And honestly, they didn't just sit on those GPUs. Sarvam has built an incredibly powerful sovereign AI arsenal from the ground up. We're talking about a 30 billion parameter model and a massive 105 billion parameter model. By aggressively targeting Indic language AI with models like Vision and Bulbul, they've built this highly localized moat that English-only global platforms simply cannot cross. Okay, so now that we know the major players, we really have to look at the entirely different physics of how this deal came together. Because inside this one investment round, we basically have 2 completely different types of capital colliding. Breaking down this $300 million syndicate, you've got HCLTech, a corporate VC, pouring in $150 million. But sitting right next to them is Bessemer Venture Partners, a traditional VC, putting in $50 million, alongside a whole host of other players, like Nvidia kicking in the remaining $100 million. The contrast here perfectly illustrates the funding physics at play. Traditional VCs, like Bessemer, answer to limited partners, right? Their primary goal is purely financial return. But corporate VCs like HCLTech, they pull cash directly from their corporate treasury balance sheet. There are no fund lifecycle limitations. Their goal is strategic integration. Bessemer brings a great network, sure, but HCLTech brings something infinitely more valuable to a startup: immediate, global Fortune 500 distribution. It really boils down to this one simple reality. HCLTech isn't making a financial bet here. They are buying distribution. And it's totally a two-way street. HCLTech buys a massive AI upgrade for its legacy services, and Sarvam AI buys instant access to a global client base. In practice, this synergy engine is just ruthless. Step 1, Sarvam builds the foundational Indic LLMs. Step 2, HCLTech integrates those models directly into their existing enterprise offerings. Step 3, boom, global clients in heavily regulated industries like banking and government deploy them immediately. This partnership literally takes the brutal enterprise sales cycle for a startup and compresses it from years down to mere months. And this dynamic is exactly why traditional VCs like Bessemer are happily joining forces with these corporate giants. They clearly recognize that in the highly capital-intensive world of AI infrastructure, corporate venture arms aren't pure competitors anymore. They are absolutely essential syndicate partners. Bessemer gets the strategic validation of HCLTech's involvement, which beautifully balances out their financial risk. But look, in any deep investigation, we always have to look at the shadows. It's not all just seamless synergy. For the founders out there and the accredited investors paying attention to this, what are the hidden risks in taking a massive corporate check like this? There are some severe strategic premium risks involved. First off, when a corporate giant is your lead investor, you're going to feel immense pressure toward a corporate acquisition rather than a truly independent exit like an IPO. Second, your product roadmap, it naturally bends to serve the parent company's needs. Third, and this is a big one, HCLTech's competitors, like Infosys or TCS, are suddenly totally off limits as potential clients for Sarvam. And finally, if Sarvam ever needs to raise a purely financial round later on, sustaining a $1.5 billion valuation that was heavily pumped up by strategic value could be incredibly difficult. So, taking all this in, how do we actually apply this intelligence? What should accredited investors and market watchers be looking out for next to catch the next Sarvam AI before it completely explodes? Well, here is your AI investment playbook. Number 1, follow the government subsidies. Programs like India AI or the US CHIPS Act are basically the new seed capital. Number 2, stop looking purely at standard revenue multiples. You've got to watch for these synergy-driven valuations. Number 3, hunt down startups founded by brilliant researchers who clearly lack enterprise sales channels. They are the absolute prime targets. And lastly, listen closely to the earnings calls of legacy IT and telecom firms. The second they report margin compression because of AI, you know for sure their corporate venture arm is about to start writing massive checks. Which leaves us with one final, incredibly tough dilemma, the very heart of this explainer. If you are an AI founder right now, staring down the barrel of global disruption, what's your play? Do you bootstrap it and fight tooth and nail for complete valuation independence? Or do you take the corporate mega check, accept all the constraints, and just hit the gas on strategic acceleration? It is quite literally the multi-billion-dollar question defining our new AI economy. Thanks for joining me on this explainer. Keep learning, keep questioning, and we'll see you next time.